Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
All right, back here on the Investor Coaching Show, I'm Paul Winkler. We talk money and investing here. And going through some questions. I had my phone with me, and people were just asking me random stuff. And I thought this would be a fun little radio thing to do from time to time. And so we talked a little bit about, one person was asking about precious metals. Another person was asking about Iran and markets. Okay, so the next question. Since we're on a roll here, let's do this. Okay. So Dave asks this question that I thought was fun.
Paul, I have a question. There's an age-old rule to invest. You take your age from 100, and that's what you ought to have in protected investments. And the other that's left, I'm 76, so according to that, 24% of my portfolio ought to be invested. Is that still a valid rule?
Okay, great. I love that one because you got the car horn in the background. That's real. Yeah, so age-old rule. You take it, how do I invest? How do I choose my stocks versus my bonds? Well, I take my age and subtract it from 100. And like he said, 76. So if I take 76 from 100, what do I got left? I got 24. So that tells me how much I'm supposed to have in stocks, 24% of my portfolio. Terrible rule. It's a terrible rule. John Bogle, the founder of Vanguard, used to say that all the time. And I would just scratch my head and go, what? Some people oversimplify things. They oversimplify investing. They really do. And, I think their heart's in the right place. They want to make it simple for people. But what happens is you throw your brain out when you make things overly simple. Rules of thumb are, problematic for me because everybody's situation is so different, number one. But then you look at the research and so what's the goal of the investor? Well, the goal of the investor is to have money set aside so that they can actually get an income from that, because you go through two stages of life. One is that you work for money. The second stage of life is money works for you. And I often will tell people, hey, you work for a company, what are you doing? You're producing something, you're producing an income. And what I loved about thinking about the stock market and retirement and investing in retirement in general is now you have all these people producing an income on your behalf because you own companies and the earnings are what you get being an owner of these companies. So that's the beauty of it, is now you've replaced one person at work, you at work, with tens of thousands and millions and millions and millions of people at work on your behalf. So if I look at what the research says about getting income in retirement, well, the Bengen research goes back to 1900, and it has been wildly debated. And, the people that have been against the research and actually fought against it over the years, they've been for it, then against it, then for it, then against it, and for it. And I laugh because they can't decide if they think the research is any good because they're not implementing it properly. I just crack up at how mutual fund companies, they talk a big game. They talk about diversification. They don't do it. But here's what the research shows. If you follow these basic rules, and this is really what Bengen was absolutely adamant about, is that when you invest, he was using data using indexes. Now, I'm not a huge fan of indexes outside of large U.S. and large international because they tend to be more costly. But I am a fan of the concept behind them, which is don't stock pick, don't market time. Don't engage in gambling with your portfolio. You don't know which company is going to be better than another. And that was the premise of an index, is hold an entire group of stocks and don't buy and sell and buy and sell and buy and sell, because Wall Street is mainly the benefactor of that. They make all the money when you're doing that kind of junk. So make sure that you're not stock picking, you're not market timing, number one. Make sure that you're owning stocks and bonds. That was a big thing that he did. And he found that the minimum for taking an income, and he used a 30-year period because he figured if you're 65, that gets you to 95. If you're 70, it gets you to 100. But in essence, he wanted to see what was the maximum amount of income that you could get. And that's where you hear the 4% rule. And sometimes people quote 5, depending on how you do it. And it can be, there are certain things you can do to change that number, to help that number along based on your level of flexibility mainly. Can I take an income one year and take a little bit less the next year and take more the year after that? Do I have some flexibility in taking income? And you can change that number to some extent. Way beyond the scope of answering this question right now, but I want you to get that there are some nuances to that research. But in effect, what he found was that the minimum you wanted to have was about half the portfolio in stocks. Well, this guy's going, I'm 76. That tells me I'm supposed to have 24. Bad research. I mean, that was the minimum. And here's the interesting thing is there's later research that shows that you can actually increase, not decrease, the amount of stocks as you get older. Because you're not worried about running out of money when you're older because your time horizon is shortening. Like it or not, that's just the way the world works, right? So in effect, by decreasing the amount of stocks as you get older, that goes against that research. And you can have 50% to 75, somewhere in that 70 to 75% in stocks to take income from in retirement. Well, that's a far cry different from 24%. So why is it that this is put out there? I can only surmise that the reason that these types of rules of thumb gain popularity because it appeals to who we are as humans. We have a tendency to be a bit nervous as we get older. Why are we nervous as we get older? Well, we're nervous about healthcare expenses, those types of things. And that's something I covered quite in depth. If you check out the video from the Channel 5 when I was on there, in depth regarding healthcare costs and the likelihood of nursing home care and the expense of it on the show. But one of the things I'm just going to hit really, really quickly on that is the amount of people. Number one, it was like 52% of people never need any long-term care. They don't need any kind of long-term care services, let's put it that way, throughout their entire retirement. 52%. It was something like 12% need less than $30,000. So just a minuscule amount. Healthcare expenses. Of course, you're going to have healthcare. You have healthcare expenses before you get into retirement. So expenses aren't that's minuscule. If we're looking at somewhere between 30,000 and 300,000, you had another something like 20% of people fell into that, and it was only like 14% of people needed more than that. And that varied a lot based on where you lived. If you lived in places like California and New York, it was double the cost of what it was in places around the South and the Southeast. So it can vary significantly. But the point I was making in the segment was that the amount of money that you had to set aside around like 60, 65, I threw out the number, somewhere because I'd seen it some study that it was somewhere in the neighborhood of 70,000. You could have enough money by the time you're likely to need long-term care services to cover them completely with that fairly modest amount. But the number went up significantly. And here's the point I want to make. The number or amount of money that you had to set aside goes up significantly if you don't invest in a more prudently designed portfolio based on Bengid's research, owning more than equities. And if you're reducing it like this, because it has such an effect on the expected return of the portfolio, it could make it that you actually have to put more aside to get there if you're being that conservative in the portfolio design. So it is rare, extremely rare, that I would want to be that conservative in an investment portfolio. Are there ever times? There might be. But the reality of it is you're holding that much in bonds. Now you're starting to take incredible amounts of interest rate risk. Because if interest rates go up, bond prices go down, and you're just exchanging one risk for another as an investor. So be very conscious of rules of thumb. I hear people say, like I was talking to this group this week, and I said, have you ever heard that debt is always bad? It's always terrible to have debt, and you never should have debt. And I'm a big fan of not having debt on depreciating items. But I'm really careful not to say that debt is always evil and you never should have it. And I said to the group, I says, do you have a savings account? And they're like, yeah. And I says, well, you're enabling somebody else to have debt. So be careful, when it comes to rules of thumb. I hear people say that, that there are, it used to be an old Lipper thing, own 4 funds, aggressive growth and income, and international. That was a big Lipper thing. Those were classifications. And I'm like, oh, great. Yeah. Rule of thumb like that. What does it cause you to do? Own large U.S. growth stocks, large U.S., large U.S., large U.S., and international large, which moves with large U.S. because those international large companies are moving with large U.S. So you end up with a non-diversified portfolio because of that rule of thumb. So often what happens is that we use these things just to simplify. There's one person that says, just buy an S&P 500 index fund. And yeah, that's great. Just buy I love the idea, no stock picking, no market timing, but you can go 20 years and we've gone 10, 20-year periods with zero returns or even negative returns after inflation when doing that type of thing with an investment portfolio. You're using a rule of thumb to make it easy for people. Or I see target date funds today, I see them all the time where they own a total stock market portfolio. And you say, hey, that's great. I own the whole stock market. And I go, hey, have you looked at a chart of a total stock market portfolio fund versus the S&P 500 that owns 500 companies versus 3,600 companies? Take a look through history. Go back and actually look at charts. I've done this in workshops before where I lay those charts above each other. There's no difference in them. It's marketing. And recognize that mutual fund companies and investment advisors so often, unfortunately, and people in the investing world, they make things super, and they oversimplify because there is something about keeping it so simple that I don't have to think that causes me to go, hey, I want to check this out. Maybe it is really easy to fix everything myself or be my own car mechanic or be my own house mechanic and house repair person. And when somebody comes out with a simple message, it's really attractive, but it can get you into a whole lot of trouble unknowingly. But it sells stuff. So recognize that. I like to keep things simple, but I don't like to go over simple because it can be the enemy of success when it comes to investing. Hey, just a note to you podcast folks, we just came out with a retirement income guide, and I'm super excited about this. There are all kinds of myths about taking income in retirement. People worry about running out of money, and rightfully so, because a lot of these myths can actually cause that. Now, the myths that you typically hear about, number one, dividends, living off dividends in retirement. Real estate, life insurance as a retirement investment, and annuities, and interest-bearing accounts, and target date funds. There are all kinds of things out there. What I want to do is put something together that walks through why those things are problematic, number one. Number two, the other thing that I wanted to do is walk through the evidence-based research on taking income in retirement. And we got a ton of data going all the way back to 1900. What's the logic behind it? And it's intensely logical. So we put that together, and all you have to do to download that, making it super simple, just go to paulwinkler.com/relax, and you can actually get into that very easily right there. So I would urge you to do that. Check it out, because I think you're going to really like it. paulwinkler.com/relax. All right, back here on the Investor Coaching Show, Paul Winkler, talking money and investing. Okay, so having fun going through some of these questions that people asked. I got another one. Kenny actually, I've known Kenny for a while, so we got into this conversation. We were just talking about costs, and one of the topics I love talking about with regards to investing because I think it is so misunderstood. And let's go through his question. Okay,
you said that there's cost to the trading that happens inside of funds. How do you monitor that?
What a great question. So the idea about cost inside of mutual funds, people often think that the only expense that they've got is the management fee. Why is that? Well, that belief comes because so many companies market. That's their whole marketing message. Costs, we're low cost, we're super, super cheap. Some fund companies actually sell mutual funds with zero management fees. And you think, well, how do they do that? Man, they're running a charity. Well, no, they're costs. And they're a lot higher than you often think because you're only looking at what we call the explicit cost, which is the one that you see. That's the management fee. And fund companies will compete on keeping that explicit cost very low because they know that attracts you, the end investor. Yeah, you'll look for that, and that'll be your criteria for actually choosing a fund. Well, you'll have, number one, you'll have securities lending revenue inside of a fund. I've talked about that before, where a mutual fund will hold securities, they lend it out, they make money on that, and they keep the revenue for themselves. That's one of the things. Now, different funds will have different expense levels. A lot of the fund companies that will keep the expenses super, super low tend to do this. If you watch closely, most of the money that they manage is going to be in large U.S. companies, which is an extremely inexpensive area of the market to manage. So we look at that and say, okay, I should have that asset class in my portfolio, but it has the lowest expected return of every area of the market. So I probably should have another area. Typically, what I'm looking for are expenses that I want to keep them in a range that's okay for the asset category. And that varies based on asset category. For large U.S. companies, you can typically keep that extremely low, 10 basis points, something like that. But the other areas of the market, international small, it might not be unusual to have 0.5% of expenses in that area of the market because it's more expensive to manage. But what happens when you're dealing with securities lending revenue, you're dealing with trading strategies, you're dealing with momentum, is a way of actually trading a portfolio to keep the costs down. There are things that you can do to actually offset a lot of those expenses. So it would be way beyond the scope of what I could do here on the show to talk about that. But recognize that you don't just want to look at the explicit cost, you want to look at the implicit cost. How is the fund company actually dealing with these things? Now, if you dig deep into the operating manuals of the mutual funds, when you get into the prospectuses and you deal with, the reports that they have, the annual reports, you can actually find what companies do with securities lending. You can find what they do to actually cut down the expenses of trading. Like momentum, let me use that as an example. Momentum is something that investment managers use to try to increase returns because they hope that they can get a stock that's moving upwardly momentum-wise, they can buy it, and then when it increases in value, they'll make money on it. Well, the research, you got to be aware of the research. The research shows that when you engage in that type of process, the cost of actually engaging it tends to offset any gains from it. But you can use it to offset expenses. So there are things that you can do, but recognize that expenses are not the only. Don't deal with commissions. I don't want commissions in the portfolio. You see these asset managers charging, 1.5%, 2% per year on top of the management fees in the funds. That gets a bit excessive. So really be conscious of it, but don't be totally driven by expenses. There's a lot more to the story. Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.